Good morning. You're watching the market right here on ET Now, and the festivities have arrived. And that's why the reason we look the way we do. But hopefully that cheer should rub off on equity markets, because it's just been so lackluster and so dragging its feet really in a very, very narrow band. And unfortunately, that range is only getting narrower by the day. And that was the case in yesterday's trading session as well. But very quickly, there are a lot of trigger points. Of course, it's a brand new month. We're going to be kickstarting the auto sales as well. We've officially now stepped into the peak of the festive season as well. So I guess everyone will be having a close eye to the ground in terms of what kind of volumes do you see in discretionary spend. But that said, today you've got the MPC outcome as well. And yes, we're just hours away from a shutdown for the US government. So important to really keep at least one eye on what's happening within the global markets and the development there. Having said that, the US markets completely seem undeterred. In fact, if nothing, it was a strong handover from US overnight. You had the Dow scaling higher by roughly about 80 odd points. The S&P was higher by about 0.5%. And the Nasdaq as well did quite okay. Asia, nothing really to write home about, but yes, the Far East is looking much brighter. You've got Hong Kong, Shanghai, both holding up very smartly. Nikkei, though, is down, and that's down over about 500 points. It seems while Wall Street have shrugged off, the government shutdown concerns, Japan seems to be taking heart from that, because right now, Japan is down over 500 points. So I guess for India markets, it's a safe zone because we've been completely ignoring all that's happening globally.
Well, yes, gold continues to inch higher.
Yes.
That's the one piece. The other piece that's standing out for me is the fact that crude remains quite controlled. And we'll have an eye on crude largely because you'll have to look domestic now, given that we have the policy today. And those factors will weigh in on what the policy will reflect, whether they choose to focus more on the growth aspect of things, whether they choose to be more controlled, given the fact that they've already done 50 bips, a couple of meetings ago, and given that clarity that, we're going to cut CRR over the next 6 months, whether they're going to be even more dovish or not will be the big question, I believe, to some extent.
The three things which are coming in for that is, one, inflation targets are going to come down because of the GST impact, and the anticipation is 50 bips of impact will happen on a lower side. So that's something which is there. The growth seems to be holding steady, but they want to push growth, then there may be a 25 bips rate cut that can come in either in this one or the next policy. But over the last 10 days, we have seen a couple of reports and economists talking about that growth is not picking up, so they need to do something about it, especially because of the uncertainty around tariff and investments getting on hold. So there needs to be a push, and with inflation being little under control, they have that thing to push the pedal end. But if that happens, your sectors are going to get impacted, banks and NBFCs.
Yes, and to a certain extent real estate as well. The other piece, if at all a rate cut were to come through, and why would that benefit, in fact, India as well? Given tariffs, a rate cut will also mean that the rupee weakens further, which gives more bandwidth to exporters from India, and it insulates them to a certain extent from the tariff as well. So all of that would likely be in focus and would likely play out.
Absolutely. In fact, shortly from now, we'll have Ankur from the RBI headquarters as well give us a color on what really the market is penciling in. It seems like it's only a slim chance that there will be a 25 bips cut, but the street is completely not ruling that out. But that said, it's important to look at the market setup as well. And I guess, Ajit, that's the same picture over there, right? I mean, yesterday too, you had the FPI selling, DIIs comforting, and sizable quantum there, 5,700 odd crore rupees. But just the F&O picture doesn't seem to be telling, as of now at least, that we're snapping out of the range anytime.
Yeah, and it's interesting because the cash market was flat. We closed about 24,600, and rightly so, because it was a range-bound trade and we had a Nifty expiry, and today we have the Sensex expiry. So activities we've seen in specific stocks. So if you look at the private banks yesterday, all of them closing flat. There wasn't any much of a change which was there in the entire private banking space there. But, the F&O story is totally different. We're starting the October series with FI Long index position at 6%, which is much lower than, I think, the lowest I've ever seen in the last 1 or 2 years actually, because in September, at the beginning of September, we had 8% long position for FIs in the Nifty futures. Now that has come down further to 6% at the beginning of the October series. So that's something there to see. If you look at the overall FI positions as part of the entire futures and options, then this position is around 10.8%. Again, that's lower than what we began October with. So Nifty futures, FIs are going gung-ho with a cause of worry could be because a lot of 35,000 crores is what we're starting the October series with for Nifty futures, and that's a very high number of if I have to use a word, short positions going into an October where we have earnings coming in and there are other aspects which are there.
All right. So couple of angles there that we spoke about. We spoke about crude imports, Sajid, and we spoke about the F&O expiry. Where the short positions are, they've of course expanded over the last couple of trading sessions, and that's something again that will continue to weigh on markets, and any unwind will obviously aid markets going forward as well.
Yes.
Any amount of unwind. So maybe that's one piece that we'll have to keep
And I think the other piece is, Sajid, the data that you've culled out, the fact that crude imports from US are on a gradual decline. So that, I mean, I don't know, do you read into that in terms of the niggling worry or the bone of contention from US's side to resolve on tariffs?
See, this is a delayed data, and we need to caveat it saying that it's a data for August. And in the month of August, we had the US-India cold vibes coming in because India was not responding to US, and US was putting a lot of voices out against India. And in that context, if you look at this number, our imports of crude in the month of August from the US has fallen to 2% of our total monthly sourcing. But at the same time, the Russian sourcing has gone up to nearly 37%. And that is something which India has been telling, that we will be buying crude from a country which will suit us and which will be cheaper for us. And that is something which is coming out in the data. So the data is supplementing what the narrative was in the month of August. Now the narrative in the month of September has changed a bit. There has been thawing of relationship. The leaders have spoken to each other. There's been trade teams talking to each other, with US coming into India and Indian team going to the US. So there has been some kind of thawing. But whether it means that the sourcing of crude from Russia has come down, it's not the case, because the US has consistently maintained that European Union and NATO needs to stop buying oil and crude and gas from Russia, and that's not happening. And unless that happens, I don't think this entire Russia angle is going to go away in any way. So in any way, and it's going to be there because we are one of the largest sourcing partners for Russia in that sense.
Absolutely. Okay. So it seems like it's the status quo, at least when it comes to that big tariff question mark. But for now, let's look at the internals.